Now in segment 5, as always, we pivot over into what is happening in the Asian theater, and we always kick it off with China. So here you can see that China's growth expectations are back to lockdown lows of 0%. In September of 2022, it was at 2%. I don't know why in February the people thought it was at 7.7 to 8%. So one of the things that we've been saying is it's between 1% and 2%. It's not what I think the market has talked about of 4.5, 5%. It is much lower, but again, you're going to start to see that stabilization, because one of the things that we've talked about from the very beginning was that China's PBOC wanted to manage credit impulses, and they wanted to manage it at 0 or lower to drain some of that excess liquidity that has built up in the system over the last decade, similar to the rest of the world. This is by no means just, only China's been printing. No, everybody's been printing, but they have to manage their currencies not only against the dollar, but against others. And they've had a lot of complexity with that, especially with the dollar strengthening, with the yen weakening, and trying to balance that approach, which is why now the expectations are too low, and you'll probably get some of that relief rally. Now, when you look at China's monthly new loans, you had that bounce. We normally bounce here. You could see that we do expect it to be fairly low, because as we were talking about at the beginning of the year, they pulled forward a lot of the LGFVs. They pulled forward a lot of that lending that was meant for the whole year. And there was some view or opportunity that they thought to see that accelerate. And we haven't seen that to date. And we don't think that it will, because we don't see a next level or another installment of lending allowed. China aggregate financing came in at 3.12 trillion versus the estimate of 2.69. So again, but you're seeing it happened a little bit sooner. It's still below where we were in 2020, slightly above where we were in 2021. But again, it's just because the credit impulses got so low that they needed to kind of bump things along and smooth that, because they don't want it to be too far negative, because then you have, some of the liquidity drain. You're already struggling with companies that can't manage their debt. This would, if you get too low, you would just exacerbate some of those issues. So just to give some of the updates on the Taiwan piece, there were 68 PLA aircraft, 10 vessels around Taiwan. 40 of the detected aircraft crossed the median line, which is that demarcation line of the Taiwan Strait, and entered into the Taiwan Southwest and Southeast ADIZ. So again, you're still getting we can't sleep on it. There's a lot of things happening right now. We've talked in segment 1 about Taiwan, China, Ukraine, Russia, and the impacts that we continue to see. So when we look at some of the shifts in general, it's important to talk about the renminbi. So while there has been less attention on the PBOC's effort to prop up the currency against other major peers, it's been working in the sense of trying to manage it. The trade-weighted basket has gained about 1.2% since the end of July, while the onshore yuan has weakened around 2% versus the dollar during that period. Much of the worry about the weak renminbi is really more about the strong dollar. And that's what they've been trying to manage. That's been the focal point. But there's other impacts as well, especially when you're looking at export currencies such as the Korean won and the Japanese yen. Both measures matter, but the renminbi's performance against a basket of currencies directly affects the country's trade as well. And more importantly, the domestic distribution of income. A stronger renminbi helps rebalance the economy towards greater consumption, which is, again, something that the PBOC noted. So they want to strengthen it, but when the inflation fears are there, when people are looking for safety, they're selling that, which then the PBOC comes in and buys, trying to kind of backstop it by selling dollars. The renminbi's performance against USD, however, seems to be a more important driver of financial flows, with expectations of renminbi weakness against the dollar causing Chinese and foreign investors to take money out of the country, which is, again, what they've been trying to do is prop up the renminbi. So buy renminbi, sell dollars, trying to manage this, which is why some people have said, they're selling treasuries because they want to, diversify against the dollar. No, they're trying to manage their currency. And because it is the second largest economy in the world, That's a lot of currency to manage. So again, you need to look at the FX rates. You have to look at the trade baskets and how they're trying to manage it, because there are a lot of moving pieces. So the renminbi's performance against dollars seems to be the most important driver. This is why the PBOC doesn't just focus on the former. It's hard to manage against two separately moving targets. When the dollar rises, the PBOC has to choose between maintaining stability against the dollar and so undermining trade, or against the basket, encouraging possibly destabilizing financial outflows. So again, that's why you see that balancing act. And to be fair, people have said that I hate China or whatever. They've done a very good job. I don't hate anybody. It's just I am looking at very specific things, and we're talking about different structures. On a financial structure, I don't like the way that China is set up right now. On a government level, I don't like the way China is set up right now. It doesn't mean I have anything against the people, and it doesn't mean I have anything against what they're trying to achieve. I have an issue of how they're trying to achieve it. What structures are they using? That is where we have that bigger disconnect. But to be fair, the PBOC has done a very good job in managing some of these key pieces. So here's when you look at money supply, and money supply was expected to be at 2.4%, came in at 2.2%. Money supply for M2 was expected at 10.7, came in at 10.6. China's central bank has asked some of the country's biggest lenders to refrain from immediately squaring off their foreign exchange positions in the market. So squaring them off means that if you get in dollars to sell dollar, if you get dollars, sell dollars by renminbi, or if you get renminbi and you have to fill that in dollars, they're essentially saying leave it open on their books. Don't close it. So you can do a accounting transfer, but you don't want to show the actual transfer, or keep it open. Don't do the financial or accounting and then close it after a set period, because they were trying to manage their FX reserves. And this is where it gets interesting as they try to manage this and manage that money supply. So and to run open positions for a while in order to alleviate downside pressure on the yuan. As part of this informal window guidance, banks have been asked to not square their positions in the interbank foreign exchange markets after any US dollar sales to clients until their spot foreign exchange positions hits a certain level. So again, this is that management that we've talked about, but unfortunately, it is difficult as somebody who's traded currencies my whole career. What they're asking to do can be dangerous in terms of some of those underlying structures. If it's a physical delivery where you're taking cash in from a client, it's a little bit easier. When you're taking a notional exposure, that's where it can get complicated of forwards, futures. But if it's cash and harder assets, the movements won't be as extreme, so then the risk isn't as much. It all depends on how is it structured and what was the counterparty risk look like. Consumption growth is running faster than overall GDP growth. Retail sales, online sales, are still elevated, but as you can see, they are slowing in general. Auto sales, auto dealer business sentiment, consumer current consumer confidence, consumer spending, that's one of them, and then bank deposits by households. So you're starting to see a little bit of that pivot. Consumers spend rather than save. So some of that is coming out, some of that is moving. But again, it's still not one for one. It's still not going to drive the growth. You're just starting to see some of that normalizing impact on the consumer front. But it's important when we start talking about China and the Belt and Road Initiative and their impacts in other areas. So the Belt and Road Initiative is a global push. It used to be called One Belt, One Road. They changed the name to the BRI. So the BRI seeks to back an array of projects, but to date, the vast majority of funds have been allocated towards traditional infrastructure, energy, roads, railways, ports, principally aimed at developing countries, Pakistan, Malaysia, Bangladesh, Myanmar, Sri Lanka. But as we know, these are areas that have struggled considerably on an economic front. So the BRI also has developed countries with numerous allies, especially in Europe, the Middle East. But it's a problem because everyone likes to say China doesn't have international exposure, or their bond issues are domestic and they can manage it. This is not domestic. You put money out, You got some of it back because you required the receiving country to spend that money on internal Chinese companies, but there's still interest to be paid. There's still collateral that is essentially non-existent. So the exposures are still very real. And I think that's the biggest issue in general. So when you look at it from this part, because U.S. allies are there, U.S. allies were to turn to the BRI to build critical infrastructure such as grids, ports, telecommunications, which could complicate some of the U.S. contingency plans. But we've seen that adjust. We've seen countries essentially walk back their involvement because of the issues on spying, on the issues of human rights, and the issues of trade. So there's a balancing act that has to happen now. I think the Middle East does it fairly well. Europe has pivoted a bit harder towards the U.S. So again, these are going to be interesting times when we look at who's going to give the next dollar, because when you're in the BRI, it makes it much harder to get World Bank money or to get IMF money, because they're essentially saying you can't pay back China before us. So there's that balancing act that has to happen in general. So China's imbalance between consumption and investment. So even though we saw it get a bit better, final consumption expenditures is still not the main driver for things as it is in other parts of the world. When you look at the US, as we've been saying, it's closer to 70%. Other areas, it's over 50%. In China, it's 38%. So even as the consumer normalizes a bit, you're not going to get the same bounce as we've seen a lot of movement away from trade, manufacturing in China. Gross fixed capital formation, that's where China exceeds and typically needs the most, but we've seen that walk back. We've seen that actually go negative, which is a problem. And then this was an interesting chart that I had seen, and China's medical costs have surged. And it's interesting to see that inflation going up and the problems that could do in terms of domestic growth and some of the key pieces on the inflation side, because we've seen some of the shifts on inflation. We'll talk about them in a minute. But here's, I think, a good comment from Michael Pettis regarding a commentary from the Financial Times article by L. Aron. So in some of the points that L. Aron talked about is reinvigorate domestic growth and restore China as a key engine of global expansion. But what would happen? Are we going to see stimulus? So his point that the stimulus many are hoping for, expecting it to reinvigorate domestic growth and restore China as a key engine of global expansion, would do no such thing and would only at best postpone the urgency with which Beijing needs to transform the growth model. So that's interesting because that's what we've been saying, something similar. Now, one of the things that we've been talking about is they've been hoping for it to reinvigorate domestic demand, but it's not going to reinvigorate domestic demand. I disagree with the fact that it's not the stimulus can't, or the way that they're set up, it's not going to restore China's global a key engine, because domestic demand, as you can see above, is not their main growth engine. It's manufacturing, it's growth, it's manufacturing, it's trade, it's investments, foreign direct investments, and that's not there. So I think that there's an interesting point to be made going forward. So despite what many may claim, may continue to tell you, it's no longer a given that China will become the world's largest economy. Now, we've always said it was too soon to say China was going to be able to eclipse the U.S. Now, we always said that the U.S. could fall on its own sword at this point, in terms of it fall under its own grandeur, its own growth. The problem was China was doing it too soon, too fast, and they were doing it with a lot of leverage, and that's where you can get caught. And that's where every time they had a sputter, instead of addressing the issue, they just paved over it with more liquidity, more lending, more debt. And eventually that you collapse under that. Now, not to say that the U.S. isn't doing it now, but we didn't do it at the beginning. And that's, I think, the biggest thing. And again, coming back to some of the reasons why we have to get back to the foundations that made America what it is, they have to do a restructuring because it's not too late. It's not like China's going to implode and then all of a sudden it's going to disappear from the world stage. They have to pause here and restructure. And I think the PBOC is doing that, and they're doing the right thing by that. But there's more to come when you look at some of the different growth. Now, those of us who understood China's structural imbalances and the nature of its GDP growth had been arguing for over a decade that the Chinese economy had already slowed substantially on comparable terms and was never likely to accelerate. Again, this is Michael Pettis's words, but for those that have been following me, that I could not have said it better myself, and that's what I've been saying. The reason is because since the late 2000s, Beijing could only maintain high rates of GDP growth above 3% by increasingly shifting the focus of economic activity from the productive, hard budget constrained parts of the economy to the less productive, soft budget constrained parts, because the latter isn't sustainable and much of it must eventually be reversed anyway. The only way to preserve the GDP growth rates that fueled the growth expectations was also what had ultimately to undermine those very expectations. This was always an exercise in how fundamentally we misunderstood what GDP means. Even most economists who really should know better seem to think that GDP is a measure comparable across countries of the total value of goods and services produced. It's a proxy for this total value, not a true number based largely on the structure of the US and British economies in the 30s and 40s that tries to measure the extent to which the real economy has grown or contracted. GDP can be useful, but can only under certain very strict conditions. The most obvious in the case of China is that the GDP measure assumes necessarily that all activity occurs under hard budget constraints and that losses are always expensed and never capitalized. The fact that GDP growth was an economic input in China and not an output should have made it obvious just how non-comparable it was. The only way to make GDP growth an input is to assume that all investment is productive. This effectively means capitalizing losses, which, as we were saying before, anytime they hit a problem or a pocket, they'd pave over it with debt and they'd move on and they would just add the leverage. Now, again, that creates those pockets of weakness, which you have to fill before you can really grow. The only way to make GDP growth an input is to assume that you're going to capitalize those losses. This has been hard to explain to economists, although engineers, mathematicians, and others who think in terms of systems find it almost trivially obvious. Without hard budget constraints, there is no way to differentiate between value creation and value destruction, which again is why we've talked so much about the debt issues and how they've created that leverage situation with LGFVs and that local government financing, which has created these problems because they've been pushing money into infrastructure, but they're not yielding, again, that negative multiplier, which we've talked about. So now when we start looking at some of the key pieces of the growth engine, here you can turn to Country Garden's monthly contracted sales. They have come down considerably when you look at so far. Coupons booked, when you look at the bonds in general, they've been able to get extensions. But again, even with an extension, when you look at the contracted sales, they've just prolonged the inevitable. Unless we get some meaningful pivot, it's unlikely that we're going to see some meaningful recovery. It is time for the markets to recognize that China is not reverting to its old economic and financial playbook, and its return to as a powerful driver of global economic growth is unlikely in the near future. Economic performance is likely to remain lackluster for the remainder of 23 and the first half of 24. Looking beyond this period, the outlook is also far from reassuring. The challenging process of reorienting the Chinese economy in the face of ongoing geopolitical tensions and the complexity of building an alternative international order possess significant hurdles. The authorities will also need to overcome their now overwhelming inclination towards centralization and instead enable but not micromanage the emergence of a powerful private sector engine of growth. Despite what many may continue to tell you, it is no longer a given that China will become the world's largest economy. Again, I don't think it was ever a given as for those, but what we've been saying is that unless you let the free market decide, the problems only get worse, and you get an exponential issue that continues to grind and create an underlying problem. And again, that's what we saw here. They relied so much on real estate, there's so much on construction infrastructure, and eventually that was going to catch up with them. Now, when you look at China's CPI, slight acceleration to 0.1, but core CPI is still at 0.8. So it's not like, the headline number is one thing, but the core CPI has still been in this key area. Now, policymakers have made a flurry of announcements at the stabilization, but one of the things that we've been talking about is none of it has meaningfully changed the property markets. And the problem is the property markets have so many overhangs that there's not one thing that's going to fix it. You're going to get a lot of that slowdown in general, which again, we don't see changing. Inventory to sales ratio of Chinese residential private property continues to be now at historically high levels. Not a good situation as the residential property inventory sales ratio continues to kind of show that slowdown. And there's a lot of capacity out there, which is why we don't see any meaningful adjustments. So even though Country Garden and some of these others may extend their duration, it's not going to fix the situation that they're currently under. There has to be an underlying restructuring. Chinese social housing construction versus private residential housing construction. So social housing construction has picked up, but realistically, it's going to help, but it'll only really partially offset the issues of the decline, but it's not going to reverse them, which is the bigger problem. The property bust, Japan land prices and Chinese new home prices, as you can see, they're kind of tracking in a similar way. It doesn't mean that you're going to get them similar because the Japanese view homes very differently than others, but it's just an interesting view in terms of the deflation that is going to happen in the country or will pressure the country in general, creating some of these underlying problems. Now, Japan's core machine orders were expected to be at negative 10.3, came in at negative 13. Japan buying foreign bonds increased to the highest levels since 2020 and the highest level in 2023. So again, the economy continues to slow. Bonds are 10 years are going right to the ceiling, and you continue to see them buying foreign bonds to bring in some of that collateral to continue to try to issue that yen as they're trying to buy that debt and maintain the ceiling, which eventually will get broken. South Korea import prices continue to move up as well as export prices. Now, this is important because we import a significant amount from Asia. And this is showing you that we're going to start importing inflation again. So those prices are going to come up, which is why that reacceleration of inflation globally has long-term impacts. India, the index of industrial production continues to be elevated. It came in at 5.7% versus the estimate of 5.3. So again, we continue to see India remain as a bright spot versus others in the region. So that's what we have for you on Asia. If you have any questions, please feel free to reach out. Otherwise, we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.